Hey everyone, it is Ian and I'm back with another trade idea today, and we're going to be going over how we look at data in the predicting alpha terminal and how we can use relative value to focus on optimizing the best trade that we can find rather than saying, oh, this is overpriced relative to this, so let's, buy this, sell that, right? And the reason that sometimes we would do this is when we think everything is expensive. And this can be for an industry, it can be for a sector, it can be for a multitude of different things. And we have a really good example right now on ticker symbol BP, which is British Petroleum. And currently, what we're seeing, just going over the numbers real quick, we have an IV30 versus FV30 of 1.47, an implied volatility versus realized volatility for 30 days at 1.53. Implied volatility for the next 30 days is at 35.6, and a forecast volatility of around 24.2. So what we're seeing is when we use the relative value tab, we can really see this. If we just turn this one off real quick and run that, if we come down here, we can really see this is pretty expensive, right? This is the non-event IV30 for BP relative to its realized volatility. We can see this is really overpriced at the top of its range, almost as volatile as it was, at the end of 2020 when we were still seeing an exuberant amount of volatility in the oil markets. So we have to ask ourselves, why is this the case right now? Right? Why are we seeing this? Why are we seeing this gap, this huge gap in applied volatility versus realized volatility? There's a couple theories I have, and I'll get to the theories in a second. But to go back to the main point of relative value, right? We can do a couple of things. Number one, we have to ask the question, is this just happening to BP or is this happening across the entire oil market? And then back to my relative value point, which one is the most quote unquote expensive? So we go back to the relative value tab, non-event IV30, RV30, and then use our ratios, right? Let's compare it to Chevron, right? The green line is going to be BP. Oh, sorry guys. The green line is BP. The blue line is Chevron. And the blue line is going to be every stock from here on out that I go with. So just remember that. We can see that we have this gap. So BP is more expensive by about 15 basis points on Chevron. Here's another example. Let's look at Shell, right? We're going to run Shell. Come down here and take a look. Again, same thing. We've seen this gap. It's another one. ExxonMobil. Let's run ExxonMobil and take a look. See what we have here. Same thing. Even a much wider gap on ExxonMobil relative to BP. Last one I'll show is ConocoPhillips. And it's going to be the exact same. Oh, sorry, that's actually a poor example. That's just a little glitch right now in the terminal. Sorry, guys. Sometimes it just happens with data. Sometimes there's after-hour stuff that just comes in and makes a mess. Anyway, last one I'll show then is Valero. Again, kind of same thing coming here on the last day, but overall we can see this gap. And it's been persistent, and as the implied volatility over the past couple of weeks has rallied relative to its realized volatility, we have seen this spread hold. So what we have to ask ourselves is, okay, well, number one, why are we seeing all of these big oil companies, oil and gas companies, have these massive, massive, massive run-ups in their spreads, right? We're seeing the realized volatility is not particularly high on them. It's not like, we're seeing an exuberant amount of realized volatility in markets. In fact, it's been some of the lowest that it's been in markets. So we have to ask ourselves, why is that the case, right? Why are we seeing this spread? Okay, and I have a couple of theories. Okay, number one, and I'm not really going to go into the details, but basically what happened in oil markets recently is the United States basically announced that they're going to be releasing 10 million barrels of strategic petroleum reserves that are set to be delivered sometime in November. The United Arab Emirates also announced that they're going to be trying to increase their oil production faster. They basically are revising their targets for 2030 and putting those targets for 2025. I don't really think that's also particularly significant considering that the UAE, while they are a big producer in oil, they're, I believe, eighth or ninth in the world. Well behind the US, well behind Russia, Saudi Arabia, etc. And besides that, there's really nothing else. So what I like to think is, okay, what we're seeing, and this is my personal view, Why are we seeing this? Right? Why could this be? Why are these big oil companies that have a ton of production in the US, there are these big refinery companies like Valero, right? Why are we all seeing this massive run up in volatility and in the spread between implied volatility versus realized volatility? They haven't been volatile. There's obviously market risk right now in the oil sector, but what could be a true catalyst? What could be the true catalyst? And I think it has something to do with this. I could be wrong. And yes, we are using weather on PA. We are using data, all forms of data. So this is the European model, right? This European model basically is a forecast tool that the National Weather Service looks at, that a ton of meteorologists look at. And next week, what we can see is that they're forecasting the hurricane to actually go through the Gulf Coast or the Gulf of Mexico. And the GFS has a relatively similar forecast track. Um, Let me just try to break this down as simply as I can. Um, Trying to forecast the weather, this time next Wednesday is extremely difficult. These forecast models change a lot, but I do want to add this as a noted risk. I think that this is a risk that maybe people don't look at. I doubt, the average investor is looking at the European forecast model between now and next Wednesday. But I thought it was important to bring into note because, A, this could be a reason why, we're seeing the spread, and B, this is probably something that most people aren't looking at. Okay, I really just don't think that a lot of people are looking at the weather in the tropics week and a half out. So just want to add that little tidbit. A couple other things. Number one, if you go on the term structure, and this is just covering the bases now, we can see that we're going to see this like hump in the term structure, right? And the reason that I think we're seeing this hump is that this is around 60 days out. And if we just go over here, what we can see is that BP is expected to release their earnings on November 1st of 2022, which would coincide with this 60 DT. I believe it was a couple trade idea videos, a few weeks back where someone actually asked me about that, and they were like, basically curious, why are we doing, 30? Why am I recommending 30 instead of say 60? And it was kind of the similar thing. It was because of earnings. We don't want to get exposure to earnings. I don't have a view on BP earnings. What I have a view on is the next 30 days appear to be expensive. I think that, what we're seeing is just a lot of market uncertainty right now with the oil markets and oil companies as a whole. And I think that, like I said, there is this risk with the weather, but these forecast models change 1,000 times between now and next week. And I think that if there is any sort of risk to do with that, then this is a great sell. So the position, what does it look like? Okay, so let's go over here. Now, pretty simple, clear cut. Okay, personally, what I think is most optimal is just selling an at the money straddle for October 21st options and delta hedging it. As we can see down here, we have our forecast volatility approximations put in, and we can see that if BP doesn't move, we should expect to make around $84. This is not factoring in time decay. This is just factoring in vol. Um, and people always ask me, well, what do you think about doing this, or what do you think about selling the straddle, above or below? I think that's fine. I recommend that sometimes. Just remember what your risks are. So if you want to talk delta, okay, we can look right here. We can see IV versus share price regression. We can see as the IV goes up, stock price goes down, right? And we see this a lot on most equities. It makes sense, right? So general concept here is, well, if your view is that implied volatility is going to come down, or it's not going to be realized volatility, and then again, you think that implied volatility is expensive, so henceforth it should come down. Based off this regression, that could coincide that, the stock BP might actually see a rally. And if that's the case, and you do believe that, because some people don't, some people just sell at the money and delta hedge, you know, what you might want to do then is, obviously you can sell like a $32 or $33 strap, right? Or you can sell a 30 or 29 strap, or you can sell puts. There's a multitude of different things you can do. And I really am going to go in depth in later videos on, really maximizing those. But I just wanted to focus on today's video of using relative value as a tool to find, you know, where we can find something that is the most expensive, right? Because does it really make sense to buy something that is expensive as well? You know what I mean? Like, does that really make sense? In some instances, it can. But this is just an example where I think that it might just be more appropriate to find the biggest, most quote unquote overpriced stock out of all these baskets of stocks and sell that. So I hope you guys found this interesting. If you guys have any questions, please let me know. And I look forward to seeing you guys in the next one. Happy trading.